it will be approaching 100% of GDP by the end of the decade, surpassing the pandemic peak. But global numbers hide a wide diversity across countries. In the figure, every bubble represents a country.
The larger the bubble, the larger the country's GDP. The figure shows debt levels on the vertical axis and debt growth on the horizontal axis compared to pre-pandemic. The higher the bubble in the figure, the more debt has increased compared to 2019. 119 countries are above the horizontal axis. For these countries, public debt is higher than pre-pandemic. The further to the right in the figure, the faster debt grows compared to pre-pandemic trends. Bubbles, as you can see, are all over the chart. That illustrates a wide diversity across countries. Therefore, fiscal policies must vary in line with country-specific factors and circumstances. But in the face of turbulent and threatening times ahead, resilience is needed everywhere. Countries should redouble efforts to keep their own fiscal house in order. Let's zoom in on the right top quadrant. Countries in the quadrant have public debt higher and rising faster. This group includes 59 countries. That is about 1/3 of the 175 countries in the chart. But their economies represent 80% of world GDP. Their economic weight makes them the main drivers of global trends. You can see many large bubbles in this quadrant. No surprise. Most large economies, including the largest, are there. Now, let's focus on the remaining 2/3 of countries in the world. There are 116 countries in the group that represent about 20% of world GDP. In the chart that you're looking at, the blue line represents all countries except for the 59 that I have mentioned before. The two lines in the chart representing the world and representing this remaining 116 countries evolve similarly up to the year of the pandemic. After 2020, as you can see, the trends diverge. The two lines actually cross in 2023. For these 116 countries, aggregate public debt is now well below pandemic levels. But going forward, it is very flat, indicating a stabilization of public debt at high levels. But the distinctive feature of the current conjuncture is uncertainty. One must go beyond reference projections.
In the words of the managing director, trade policy uncertainty is off the charts. Upside risks to public debt projections dominate the outlook. The October 2024 Fiscal Monitor introduced a novel tool to quantify the distribution of debt risks around the reference projection. We call it public debt at risk. According to this tool, global public debt 3 years ahead would come at 117% of GDP in a severe adverse scenario. Recent developments, with sharply increasing and persistent uncertainty, tightening of financing conditions, push public debt at risk even higher. In a fast-changing and perilous world, ministers of finance must act urgently and decisively. They face stark trade-offs and painful choices. Policymakers should invest their political capital in building confidence and trust. That starts with keeping their own houses in order. That is especially important in a situation that tests the resilience of individual economies, not to mention the entire system. Putting house in order involves three policy priorities. First,
Fiscal policy should be part of an overall stability-oriented macroeconomic policies. Second, fiscal policy should, in most countries, aim at reducing public debt and rebuilding buffers to create space to respond to spending pressures and other economic shocks through a credible medium-term framework. Third, fiscal policy should, together with other structural policies, aim at improving potential growth, thereby easing policy trade-offs. In these times of high uncertainty, fiscal policy must be an anchor for confidence and stability that contributes to a competitive economy, delivering growth and prosperity for all. Ministers of Finance must build trust, tax fairly, spend wisely, and take the long view. My colleagues and I are ready to answer any questions that you may have.
Thank you, Vitor. We will now open the floor to your questions, but before we do that, a couple of ground rules, please. If you want to ask a question, please raise your hands first, wait until I call you, and a colleague will give you the mic. And when you ask your questions, please identify yourself and the network you're working for. And for colleagues online, please ask your questions on WebEx, and we will come to you. So we open the floor. We will start here, and then we will move on the other side of the room. The gentleman on the second row, please.
Mohammed Al-Mamlaka TV from Jordan. According to the report, raising tariffs and trade tension have increased uncertainty and risks to economic growth. How can affected country manage the negative impact on public revenues and growth, especially considering the high level of debt, public debt, and financial challenge they are already facing? Thank you.
Thank you very much for your question. That allows me to summarize again the top-level message from the
Fiscal Monitor. Global public debt, as you said, is high, rising, and we always emphasize it's also risky. It rose above $100 trillion in 2024, and that was a headline 6 months ago. In the IMF reference projections, that will continue rising, approaching 100% of GDP by the end of the decade. But what we emphasize most at this point in time is the unusually elevated degree of uncertainty. To repeat the quote from the managing director, trade policy uncertainty is literally off the charts. There is therefore a sense of urgency in policymaking. According to our public debt at risk tool, our estimates for 3 years ahead point to debt at risk at 117% of GDP for the world, which is a level that has not been seen in many decades. But even that extreme adverse scenario may be underestimating tail risks because trade and geoeconomic uncertainties escalated, financing conditions tightened, financial market volatility is visible from headlines, and spending pressures have intensified further. So, in those conditions, the point about countries keeping their own houses in order is crucial, and that is instrumental to deliver resilience and sustained growth from a long-term perspective.
Thank you, Vitor. As you may have seen, there are 2 chapters. The second one is on emerging markets, and I think Ira and Davide, we have some questions for you too. Other questions? Okay, the lady, 3rd row in the middle, and then I will move to the other side of the
Alexandra Sidych, Deputy Editor-in-Chief of the New Voice of Ukraine. My question follows. Given the current global economic shutdown, what are the specific challenges and impacts faced by emerging and developing countries? And what policy measures can be implemented to mitigate these effects? Thanks a lot.
Thank you for your question. So perhaps let me start with what we see as some of the key sources of uncertainty that emerging market and developing economies are facing. Vitor had laid out some of the broader issues, but let me highlight three. So in addition to the fact that we see growth prospects being marked down across the board, and we see that emerging market and developing economies could be impacted through trade, financial and commodity channels, let me highlight three specific risks. The first is escalating uncertainty about tariffs and associated policies. And in the Fiscal Monitor, we find that geoeconomic uncertainty, in particular, an escalation of geoeconomic uncertainty actually can push up debt over the medium term by about 4.5 percentage points. And for emerging market economies in particular, it could be as high as 6% of GDP. Now, why is this the case? Because essentially, with higher geoeconomic uncertainty that can dampen growth prospects, it lowers revenues because consumption, production tend to fall. It also leads to higher spending. So as a result, fiscal positions deteriorate and debt increases. So that's one important source of risks. A second source of risks is more volatile financial conditions. In the US, for instance, or other systemically important economies can spill over into emerging market and developing economies. And it can do so by raising sovereign borrowing costs. So our analysis in the Fiscal Monitor shows that a 100 basis point increase in US nominal treasury yields translates into 100 basis point increase in emerging market economies' borrowing costs. And this lasts for several months. A third source of risk is that we've seen that debt levels are high in many emerging market and developing economies. So interest expenses are commensurately very high, and they're eating up a larger share of the budget. So our analysis shows that a 1 percentage point of GDP increase in interest expenses results in crowding out of other essential items within the budget, such as social spending and infrastructure investment. So as Vitor pointed out, in this environment, it's very, very important for countries to put their own fiscal house in order. What does that mean? Country specifics vary, but what it really means is that countries need to think about putting in place a gradual fiscal adjustment within a medium-term, credible medium-term fiscal framework. For EMDEs, where tax revenues are low, they can mobilize additional revenues by expanding the tax base. They can eliminate energy subsidy and other types of subsidies that can be distortionary. They can find ways to reprioritize spending. And most importantly, they can think about the policies that are needed to boost growth, because that really can help ease these fiscal trade-offs.
Thank you, Ira. Another question on emerging markets, please. The gentleman with the white shirt.
Sorry, Erwan Luca from IFP. My question is about energy subsidies and perhaps pension reforms, which is not related to emerging market, but pretty much the same problem. It's where the margin exists in many countries when you want to have some fiscal space. But in those many countries, you have already social tensions that are quite high. So what are the possibilities for countries to make those reforms that are highly unpopular most of the time if they want to have this margin created? Thank you.
Thank you. So let me talk about energy subsidies, and my colleague Davide can speak a little bit about pension reform. So as you correctly pointed out, countries need to reduce debt, they need to create fiscal space, and energy subsidy and pension reforms can be important reforms that countries can undertake in order to generate fiscal savings. So when we look at energy subsidy reforms in particular, they account for about 1.5% of GDP on average in emerging market and developing economies. And reforming them can have tremendous benefits for the economy. So let me enumerate some of them. First, it increases energy efficiency in the economy. Secondly, it generates fiscal savings that can then be used to increase other types of social spending and needed priority infrastructure investments. And finally, many of these subsidies tend to be highly regressive. So they don't necessarily benefit the poorest segment or the most vulnerable segments of society. In our Fiscal Monitor Chapter 2, what we did is we developed a novel real-time measure of public sentiment. This is the sentiment of households, civil society organizations, other stakeholders, to gauge how can governments leverage strategies in order to make these kinds of reforms acceptable. And there's a number of things that we found that are specific to energy subsidy reforms that I would like to talk about. The first is that we found that reforms that are, or changes that take place gradually have greater success of being implemented. To give you an example, Colombia very recently had an energy subsidy reform. They implemented it over a 2-year period that was pre-announced so that people had time to adjust. A second strategy that we found successful, to be successful in shaping the acceptability of these reforms is that there was timely implementation of accompanying measures. And in countries that put in place accompanying measures to really protect and support the most vulnerable, countries that put in place measures upfront and invested in social programs, in social infrastructure that was very visible to the public, had a greater chance of succeeding. We also found that policies that were well communicated, that built consensus, that explained the trade-offs to people, had a much higher success of being accepted by the general public. And for example, Morocco made it very clear that there was going to be a comprehensive communication strategy at the very beginning, at the very outset, and the message that was conveyed was that subsidies were a poor instrument for providing social support. And so a host of these strategies can be used by countries to implement these politically challenging reforms.
Yes, the chapter also dwells with pension reforms. We know that in many countries, spending on pension is quite high. Just to give you a couple of numbers, in the case of advanced economies, it's 8% of GDP, in emerging market about 4%. And this spending is projected to increase due to increasing life expectancy at retirement. So reforming pension system is important to generate fiscal saving, but also to sustain labor force participation as well as employment. So some of the key messages that we find in the chapter as to advance reform touch upon some of the issues that Era mentioned, gradual and timing of the reform. But for pension, what we find is that strategic communication and stakeholder engagement has been especially important. Indeed, there are cases of countries that have succeeded to implement a significant reform. For example, presenting an increase in retirement age as a part of the reform that was trying to sustain adequacy benefit levels. Or in some cases, they were creating bipartisan commissions where they were engaging with stakeholders to hear their concern and think about how to implement the reform in the best way. An important issue also when we think about pension reform is strengthen financial literacy and make sure that various stakeholders have a sense what are the potential benefits and costs of various pension schemes.
Thank you. A very last one before we move to the US and the other countries and regional. I think the lady in pink, and then we will move to other topics.
Thank you. I'm Nancy Naji from African Independent Television, AIT, Nigeria. I still want to focus on the chapter 2 because we're talking about developing economies and public sentiments. And Era, when you were talking, you talked about subsidies being this stationary, that's not making the budgets, complete and all of that. But we also know that for many developing countries and even frontier economies, they are under pressure to cut back energy subsidies to ease debt burdens. Yet these same subsidies often help keep the lights for millions of families, low-income families, and businesses. You talked about growth earlier on. So without these low-income businesses, how would you also get growth? So how does the IMF suggest governments balance this, manage this delicate balance and enable these countries to rationalize subsidies while safeguarding energy access and cushioning the most vulnerable without leaving them behind? Because we are torn between having to think that subsidies are really 100% bad. So I would really want you to comment on that. Then on Nigeria, energy subsidy reforms that we've seen have sparked protest and public frustrations, reflecting a tough balance between fiscal responsibility and social equity. How do you think that Nigeria can navigate this difficult path, and what specific measures can the IMF suggest to help to ensure that these reforms are fair, inclusive, and accepted by the public? Thank you.
So if you don't mind, we will finish with emerging markets, and we will keep the Nigeria question for the regional one. Thank you.
So let me talk in more detailed about subsidies. Thank you for your question. These are challenging reforms to undertake. And why? Because they impact people's public, small firms' pocketbooks immediately. So an increase in energy prices, as the government is moving towards cost recovery, pricing, impacts pocketbooks immediately. So, and this is a very tangible impact. Whereas the benefits that I spoke of, which is energy efficiency, the ability to reallocate fiscal savings, take time to materialize. And they're much more diffuse. Everyone benefits from those, but the pocket impact is felt immediately. And this is why it's really important, as we note in our chapter, this is why it's really important to have, for governments to think about a comprehensive strategy on how to implement these reforms. And when you look at public sentiment across different sort of steps of these reforms, what we find that's really important is that countries that put in place compensatory mechanisms, whether this is cash transfers or more targeted transfers, really for those people who need it most, have an easier time in carrying out these types of reforms. So in environments where the public doesn't trust the government or there's weak accountability, doing these things up front in a very visible way, increasing support for social programs, makes it very tangible to the public that the government is going to be doing this and it's going to be accountable, if you will, for the fiscal savings that will be generated.
Thank you. So back to the room, please. Any other questions? The gentleman, yes, the gentleman on the first row, and then we'll go to the lady in green.
Thank you. Good morning. Inga Nemushin, RIA News Agency, DC Bureau. So as risks for the fiscal outlook have intensified, right, and debt levels may rise even further, as it's stated in Fiscal Monitor, how worried are you about any sort of global debt crisis or regional crises that can appear, taking into account slower growth and new spending pressures on countries? Thank you.
Thanks for your question. As you heard yesterday, recession and crisis, more than an individual nature, are not in our reference projections, although, of course, part of the role of the Fiscal Monitor is precisely to systematically look at risks and vulnerabilities, and our public debt at risk tool is one of the instruments to do exactly that. Now, one point which I believe is very important is that precisely because risks and uncertainty are so elevated right now, there is a sense of urgency in policy action. Why? Because there is still time to adopt policies that improve resilience, and there is still time to think through what are the most relevant vulnerability scenarios that apply to individual countries, to regions, or even to broader systems. And it's very important to do that result systematically so that one is ready if and when a crisis comes. Our experience during the pandemic showed that countries that had easy access to financial markets and ample fiscal space did substantially better than others at managing the shocks associated with the pandemic.
Thank you. The lady in the green, and we'll get back to this part of the room.
Hi, my name is Ray. I'm with 21st Century Business Herald, Guangdong, China. So my question is that you just mentioned the public debt remain very elevated, and also this would cause the physical space to continue narrow down in many countries, including some major economies. So what consequence will this bring to the world global economy if this kind of situation continues to develop?
So I think that the answer that I gave to the question just now applies. Given these elevated risks and uncertainties, it's crucial that countries focus on keeping their own house in order, since situations around the world are so diverse, as Era emphasized, that will imply different policies in different countries. But the crucial thing is that in a situation that is as fast changing as the one we're facing now, and where risks and uncertainties are so elevated, there is a urgency in acting to improve fiscal space, build buffers, and therefore be in a position to ensure resilience and sustain growth.
Thank you. We will get back to this part of the room. The gentleman with the red shirt, please.
Thank you very much. Julian Tamboko from Nation Media Group in Nairobi. Allow me to backpedal to the EMDEs. The Fiscal Monitor speaks about the need to widen the tax base. A number of frontier market economies have been rolling out significant economic presence tax and minimum top-up tax in line with the Pillar 1 and Pillar 2. But now this puts them in crosshairs with the Trump administration, and many are now wondering whether they should be rolling back. So which pathways does the fund see as sustainable, considering many are looking at preferential access to the American market?
Yes, so regarding the tax, I think it's important to make three important points. The first is that in a current situation where many emerging market developing countries are characterized by three factors. One, foreign aid is declining. Second, we have seen that increasing financial volatility can increase interest rate in these countries. And this is in a situation where interest rate over revenue for many countries is about 10% of GDP. And third, the financial conditions will also imply that less flows will go to these countries. So the point that we make in the Fiscal Monitor is that the revenue and revenue mobilization can be a stable source for financing significant spending of social benefit or public investment. How we go about it, strengthening revenue mobilization, typically there are three sort of arrows that you can go. One is expand the tax base. Second, eliminate tax exemptions. And third, which is also important, and the IMF does a lot of work in terms of capacity development, is strengthening tax administrations. So when we think about the tax strategy, we have to consider all these three elements. And for many emerging market low-income countries, there are significant potential tax gains that can be achieved.
Yes, please.
Just one word of addition. Davide correctly pointed out these three very important elements: broadening the tax base, dealing with tax expenditures, and strengthening revenue administration. Yesterday, I participated in a high-level panel precisely on the mobilization of resources, and these three elements were repeated by the ministers of Pakistan, Paraguay, and Rwanda, and they found this frame relevant in their own experience of trying to improve the capacity of their countries to mobilize revenues.
Thank you. I think we will go online. We have two questions online. I think this one will be for you, Ira, about Spain. We have Carlos Asensio, El Economista. Yesterday, they revised upwards the growth of Spain and have already highlighted the good performance of the Spanish economy. what should this country do with these good growth results regarding its fiscal policies in the short and medium term? And we will have another one for South Africa, but Hillary is online and she will be able to ask him.
Okay, thank you for the question. So given Spain's relatively strong position, fiscal position, as well as economic position, there is scope now to front-load some of the adjustment that they were thinking about, because public debt levels in Spain still remain very high. Although they have come down from the pandemic peaks, they still remain very high. And this would be really important to put debt firmly down on a downward trajectory. An accumulative adjustment of about 3% of GDP over the next 3 years, say 2025 to 2029, similar to the one that was envisaged in terms of magnitude by the authorities, but more front-loaded, would help achieve the goal. Now, as Vitor has pointed out, we're encouraging countries to bring debt down for a number of reasons. This is important because you want to reduce debt risks. This is important because countries should either expand or replenish the buffers that were diminished in the wake of the pandemic, and also because of ongoing uncertainties, and finally because countries like Spain will need to spend on other areas: population, aging, climate, defense, and such.
Just before we go to South Africa, any other European question? One time, two time, no European question in the room? Okay, so Hillary, we are coming to you.
Thank you. This is Hillary Jaffe from Business Day. A question on South Africa, but also on the broader region. On South Africa, the IMF is quite significantly more pessimistic on the fiscal trajectory than our own government, which sees debt stabilizing, whereas the IMF sees it rising to close to 90% of GDP at the end of the decade. So why are you so much more pessimistic and so of the authorities' promised consolidation? But also on the region, Sub-Saharan Africa more broadly, how do you see the impact of what's happening globally on the region's ability to borrow, and particularly to borrow in international markets? And given that a lot of the countries in the region are in debt distress or close to debt distress, what impact will that have on the economies of Sub-Saharan Africa? Thank you.
Thank you very much. So very briefly on South Africa, the general government deficit in South Africa was about 6% of GDP in 2024. And we project the fiscal deficit in 2025, although this is subject to considerable, all projections are subject to considerable uncertainties at this juncture, to be around 6.6% of GDP. And this is mainly driven by higher spending. And some of the differences, Hillary, that stem from the fact that our projections are based on much more conservative assumptions regarding the buoyancy of the tax system, as well as the extent of primary spending compression that can be undertaken. So that really accounts for differences in projections between the two countries, and also the path of debt going forward. Let me turn it over to Davide.
Yes, more broadly, and on financing costs for the sub-Saharan regions, let me point out two factors. The first is that, of course, we've seen interest rate rising. So this increase in the interest rate in many countries, including South Africa, is basically driven by two factors. You have sort of interest rate in main advanced economies that has been on a rising trend. On the positive side, in many countries, especially those with better fiscal position, we actually have seen spreads, so the difference between their domestic interest rate and the foreign interest rate, to decline. However, and this is something that we point out in the fiscal monitor, that increase of risk of uncertainty, financial market volatility, can turn these things around. In other words, we see that increasing financial market volatility globally can lead to increase in spreads. The second point is that one pattern that we've seen for many low-income countries since the pandemic is that they are relying much more on domestic issuance of debt rather than the foreign market. This is, on the one hand, sort of offset some of the challenge related to the global environment, but also increase some sort of domestic vulnerability because sometimes the interest rate are high. So there is important to think about the trade-off about this strategy. But definitely, as we mentioned, interest rate is a source of rising in terms of revenue is a source of concern. And let's make the point again that we made. I think strengthening fiscal buffer, revenue mobilization, important element to reduce and have this trend to decline.
Thank you. I believe we received some questions for Latin America, and there are some reporters in the room. Please, the lady on the third row here.
Thank you. Hi, Maria Rosa Villalobos from Peru. You already talked about emerging markets, but focusing in Latin America, I want to know which one, you already have talked about it too, but which one is the biggest fiscal risk, and what should economies in Latin America should be thinking about doing in terms of growing and accepting new investment, for example, to confront the situation abroad. Thank you.
So thank you for your question. So many of the risks that other emerging market economies face, countries in Latin America obviously also face. So we've already talked at length about that. But I'm going to talk about a few things that are specific to many of the countries in Latin America. So there's two, I think, challenges that limit fiscal flexibility in Latin America. The first is that there's spending rigidities. What I mean by that is that there's a large amount of spending that is mandatory on pensions, on wages, on transfers, and this leaves very little room for fiscal flexibility. At the same time, like many other emerging market and developing economies, spending pressures are on the rise. There are growing demands for social services, for infrastructure, for climate change adaptation, for adapting to climate change, and all of these are putting pressures on the budget. Now, when you look at what has happened since the pandemic, countries have made ambitious plans to consolidate their budget. So there have been ambitious announcements of fiscal consolidation plans, but at the same time, expenditure increases have outpaced revenue gains. So for many countries in the region, we see debt levels continuing to rise. And the challenge here is that we are in a world with greater uncertainty than we were even 6 months ago. And so it's really important for countries in the region to implement, at a minimum, the announced fiscal consolidation plans, and to do this within credible medium-term frameworks. Many countries in the Latin America and Caribbean region have fiscal rules. So to implement these rules, to spend efficiently, to think about the types of fiscal reforms that are needed, whether it's revenue mobilization in countries where revenue to GDP ratios are low, whether it's spending prioritization or reprioritization, to create the room that is needed for priority investments on social spending and infrastructure and such.
Thank you. And the very last one, I think we had one for MCD region. I think it was on Lebanon. Is the journalist in the room? No, he's not? Okay. So one last question will be, please, sir. And it's the last one we're taking.
Thank you. I'm from Bangkok, Thailand. I want to ask about the overall trend of the public debt, especially for the ASEAN 5. And it would be great if you can mention specifically on Thailand. Thank you.
And I think we had the Nigerian question to answer too, and we will close there. Thank you.
Yeah, let me start with Nigeria. Nigeria managed to do a very difficult reform that was important to deliver fiscal saving. The authorities also scale up targeted transfers. What we think there is what is important to act on two pillars. One, generate additional fiscal saving. We mentioned revenue mobilization to really scale up spending on social protection, spending on investment. However, as I mentioned, many countries, they need to spend, and there I want to go back to Vitor's first remarks. What we recommend countries is to spend very wisely. So strengthen prioritization in terms of spending, strengthening the efficiency of spending is important. And finally, an important message I would like to give for Nigeria, but also for many other countries, is that fiscal institutions are very important. Having a medium-term fiscal framework, public financial management are key important because on the one hand, they try to help the fiscal anchor, so they set a path for the fiscal adjustment, but also reduce fiscal uncertainty per se. So as Vitor mentioned, we want fiscal to be a source of stability and not a source of uncertainty, and that is where fiscal institutions have an important role to play.
Thank you. Very quickly, Ira.
So on ASEAN, there's a huge variation in fiscal positions across the region. On average, in the ASEAN region, debt to GDP ratios are lower than they are in other emerging market and developing economies. That said, in Thailand, relative to the other countries in ASEAN, debt levels are slightly more elevated, over 60% of GDP. And our advice has been that fiscal policy should be prudent and parsimonious, given all the reasons that we've discussed over the course of this this morning. And so measures that are needed to smooth adjustment in light of higher tariffs should be thought of in a wise way, temporary, targeted measures in the context of tariff uncertainty, and ongoing consolidation plans implemented to bring that down in a sustainable manner.
Thank you. Thank you very much, Ira. Vitor, a last word, the very last one, and...
I'm fine.
Okay, he's fine. So thank you. In the uncertainty, he's fine. So this is a positive, a positive thing. Okay, thank you very much for joining us during this press briefing. Just a reminder for you, the Managing Director's press conference is tomorrow at 8 a.m. We will also have regional press conference for the 2 next days. For the program, please look at our imf.org website. And if you have any follow-up questions on the fiscal monitor, please send them to me and my colleague Eva. Thank you very much and have a good spring meetings.